Old dividends. Well, I'm not going to waste time chit-chatting with you. Do you know why?
Because we got some pros.
Indeed we do. Big guest. We're going to bring in the experts. On the technicals, we've got Larry Shover. He's the Chief Investment Officer at SFG Alternatives. And on the fundamentals, lucky us, we've got John Burbank, founder of Passport Capitals. John, let's start with you. 2013 has kicked off. What's your outlook?
My outlook is it's probably a good year for the equity market as long as central bank buying continues, which it looks like it's increasingly happening. The thing we're interested in here is credit. Credit spreads have tightened so dramatically, which leaves equities looking pretty attractive relatively. The big problem for equities, though, is that growth is not going to do what the estimates say they're going to do, and growth slowed last year. We were very short a year ago on that basis. But all this central bank easing and liquidity provision has been making people take risk and tightening spreads. So we think allocators are being forced to now buy equities, and hedge funds are certainly positioned for that. But because they're positioned, we also have the risks ahead of the debt ceiling debate that we may put in a short-term top.
Short-term top on what? The bonds? The equities? I mean, I'm not sure I'm following you, John.
So I like equities relative to credit a lot. However, risk, the VIX just hit an almost 6-year low today, and hedge fund nets are at 57%. So it's I just think we've had a big reversal the second half of last year into right now. I think we probably get a pullback. We probably go through the debt ceiling debate. There's uncertainty there, and then I think if this liquidity situation keeps up, equities should outperform credit.
They certainly would if those metrics stand. Larry Shover, maybe you can shed a little light here. What's your take on what's happening as you compare the different asset classes to one another?
Yeah, well, right now we're seeing definitely a correlation drop in equity sectors. That's a healthy thing for the market. We're in a period of macro tranquility. That's the best way to put it. That's why the VIX is as low as it is. That's why we have mixed earnings reports from Bank of America and Citigroup, and we still have the bank index up on a day and the S&P 500 at multi-year highs. It just seems like it's a tranquil market. The central banks around the world are going to keep their foot on the gas pedal, pushing us out on the risk spectrum. I think they call it financial repression. It's going to force people off to the sidelines and continue to add equity exposure. And I think right now there's a lot of really good accelerated EPS revenue stories out there, like Newmont Mining, United Parcel Service, Barrick Gold, some very good opportunities. I think that's what we're going to continue to see in 2013.
John, I want to bring you back. You were just mentioning that equities should outperform credit, and fundamentally, you're not alone. We hear that over and over, but when we look at outflows over the last 20 months, they continue to go out of equities into credit. When are we actually going to see the investment shift?
Well, I think January has been positive for equities, but you're right. Since 2006, a huge amount of money, I think $800 billion has gone into fixed income, and very little money has gone into equities. So prospectively, I'm saying that going out in the risk curve is likely to force people more into equities, and relatively, it's a better deal for high-quality companies. I will say that the lack of correlations and the low volatility is conducive very, very much this year for stock picking. I think we're in a market where you can make money both long and short, which is not the way it was since the crisis. Right. I should hasten to say that.
Do you think investors are being foolish who are just continuing to buy in to all these credit new issues and even credit in the secondary market, just assuming, well, default rates are so low, interest rates are where they are, I'll just keep buying credit? Are they being blind fools here?
There's a lot of momentum. There's a lot of demand, and it's when the demand stops where there's a problem. The risk reward is not nearly as good now. I'm saying the risk reward is much better for many, many equities than it is in credit. But, it's when I shorted subprime, I thought I had a great deal at the beginning, and spreads tightened dramatically more. So over the next year, it's very, very hard to pick a top in these things.
All right, so John, let's talk about some of the sectors where you are placing your bets. What do you like versus what you don't like?
Well, we like larger, mid and larger cap companies that are high quality and generally world-class leaders. We like companies that have premium shareholder orientation and governance. We think, however, companies that are predicated on global GDP growth, things that have flawed business models, things with poor governance are shorts and things to be avoided. I do not believe everything's going up. I do believe that in this market, premium companies are going to get rewarded because I would say that governance is probably at an all-time high here. Certainly in my career, I see companies rewarding shareholders and being aligned with shareholders more than I've ever seen before. So we want to stay with those. So I like areas, I like things across the board. Actually, we can find these kinds of situations. I like things in healthcare. I like internet. I like certain things in consumer. Although I'm very cautious on the U.S. consumer right now and U.S. consumer stocks. I like certain things in base materials like specialty chemicals. Very few gold names. And I'm very, very cautious, however, on global growth. We thought China would bounce, that there would be a first half recovery, at least in sentiment, and we're getting more cautious on that now as it's been priced in.
Well, John, I know we're going to hear more from you throughout the hour, but it's time we need to thank Larry Shover, Chief Investment Officer over at FSG Alternatives, joining us from Chicago. And as I said, John Burbank, founder of Passport Capital, joining us from San Fran, and John will be with us throughout the hour. Adam, we just got started with sectors. We're going to talk about a lot more with Mr. Burbank in just a few.